the 3 easiest ways to save on stock market taxes. Investing in the stock market can be a great way to grow your wealth. However, it also comes with tax implications that can hurt your profits. However, there are several strategies you can employ to minimize your tax liability and maximize your after-tax returns. Here are 3 easy tips for saving taxes on stock market income. 1. Hold investments. Long term. One of the simplest yet most effective ways to save taxes on stock market income is to hold your investments for the long term. When you sell investments for more than a year, the profits are classified as long-term capital gains. These long-term capital gains are generally taxed at a much lower rate than short-term gains, which are profits from investments held for less than a year. For example, in many countries, short-term capital gains are taxed at your regular income tax rate, which can be as high as 30 to 40%. However, long-term capital gains are often taxed at significantly lower rates, sometimes as low as 0% to 20%. This means that by simply holding your investments for more than a year, you can drastically reduce the amount of taxes you owe on your profits. Moreover, holding investments long-term aligns with compounding principles, where your investment earnings generate their own earnings over time. This can lead to substantial portfolio growth. Additionally, by avoiding frequent trading, you minimize transaction costs and market timing risks. Market timing can be risky because predicting short-term market movements is extremely difficult and often leads to poor investment decisions. In summary, if you want to maximize after-tax returns, consider a long-term investment strategy. Not only can this approach reduce your tax liability, but it can also enhance your overall investment performance by leveraging compounding power and reducing transaction costs. 2. Tax loss harvesting. Tax loss harvesting is another effective way to save on taxes by offsetting gains with losses. Here's how it works. If you have investments that have lost value, you can sell them to realize a loss. This realized loss can then be used to offset gains from investments sold at a profit, thereby reducing your overall taxable income. For example, let's say you have stock that you bought for $10,000, but its value has dropped to $7,000. If you sell this stock, you will realize a $3,000 loss. You can then use this $3,000 loss to offset any capital gains you've made during the year. If you had a capital gain of $5,000 from selling another stock, your net taxable gain would be reduced to $2,000, $5,000 gain, $3,000 loss. Be aware of the wash sale rule. This rule states that if you sell stock at a loss, you cannot buy the same or substantially identical stock within 30 days before or after the sale. If you do, the loss won't count tax-wise. To avoid this, make sure you wait the required 30 days before repurchasing the same stock. You can also buy different stock that is not considered substantially identical. Tax loss harvesting can be particularly useful at the end of the year when you're reviewing your portfolio and looking for ways to reduce your tax bill. By carefully managing your gains and losses, you can lower your taxable income and save on taxes. Just remember to follow the rules to ensure you get the most benefit from this strategy. 3. Invest in tax-efficient funds. Opting for tax-efficient funds like index funds and exchange-traded funds, ETFs, can also help you minimize taxes on your investment returns. Here's why these funds are beneficial. Low turnover rates. Index funds and ETFs typically buy and sell investments less frequently than actively managed funds. This lower turnover rate means these funds generate fewer taxable events, such as capital gains distributions. The fewer tax events you have, the less taxable income you have, and the lower your tax bill will be. Lower taxable distributions. Since index funds and ETFs don't trade as often, they distribute less taxable income to investors. Actively managed funds, on the other hand, often trade more frequently, leading to higher capital gains distributions that you'll need to pay taxes on. By choosing index funds and ETFs, you can reduce taxable income and keep more of your returns. Cost-effective. Index funds and ETFs are generally more cost-effective than actively managed funds. They typically have lower expense ratios, meaning you pay less management fees. Lower fees mean more of your money stays invested and grows over time. Over the long term, these cost savings can add up significantly, boosting your overall investment returns. Simplicity and diversification. Investing in index funds and ETFs can also simplify your investment strategy. These funds often provide broad market exposure, offering diversification with a single investment. Diversification spreads risk and improves investment performance over time. Plus, with their low fees and tax efficiency, index funds and ETFs are a convenient and effective way to invest in the long term. By choosing tax-efficient tax-efficient funds, you can enhance your investment returns while minimizing taxes, making it an ideal approach for long-term investors. This strategy not only helps you save on taxes, but also aligns with sound investment principles like diversification and low-cost investing. So there you have it, folks. These are some solid strategies to save on taxes on your stock market income. Holding investments long-term, practicing tax loss harvesting, and investing in tax-efficient funds. By implementing these tips, you can keep more of your hard-earned money and boost your investment performance. If you found this video helpful, hit that like button. Subscribe to the channel for more tips and tricks, and share this video with your friends and family who might benefit from these strategies. Also, let me know in the comments if you have any other tax-saving tips or if there's a topic you'd like me to cover in future videos. Thanks for watching, and until next time, happy investing.